Picture this. Somewhere in a vault in London, a trader is staring at his screen, watching silver inventories tick down to levels that make his palms sweat. He's been in this business for 20 years, and he's never seen anything quite like this. The numbers don't lie. Silver is disappearing from the market at a pace that defies logic, and most people have no idea what's coming next. We're not talking about a temporary blip. We're not talking about a seasonal fluctuation. We're talking about the fifth consecutive year of structural deficits in the silver market. 5 years. Let that sink in. For 5 straight years, the world has consumed more silver than it has produced. And the gap isn't closing. It's widening. The Silver Institute just released data showing that global silver demand is running at over 1 billion ounces annually, while mine production struggles to keep pace. Industrial demand alone accounts for more than half of all silver consumption, and here's the kicker. That demand is accelerating. Solar panels, electric vehicles, 5G infrastructure, medical devices. Every single one of these technologies requires silver. Not wants it, requires it. There is no substitute that matches silver's unique combination of electrical conductivity, thermal conductivity, and reflectivity. Think about what's happening in the solar industry right now. Every solar panel contains about 20 grams of silver. Doesn't sound like much, right? But when you're installing hundreds of millions of panels globally each year, those 20 grams add up fast. China alone is projected to install enough solar capacity to consume hundreds of millions of ounces of silver, and that's just one country, one sector. Now layer on electric vehicles. The average EV uses about twice as much silver as a traditional combustion engine vehicle. We're talking about an extra ounce or more per vehicle. Global EV sales are exploding, millions of units per year, growing exponentially, each one pulling silver out of the market permanently. That silver isn't coming back. It's not like gold sitting in a vault somewhere. It's consumed, gone, scattered across millions of devices in microscopic quantities that will never be economically recoverable. But here's where it gets really interesting. While industrial demand is soaring, mine production is actually declining in some regions. Silver isn't typically mined on its own. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So when copper prices drop, or when a zinc mine becomes uneconomical, silver production drops too, even if silver prices are rising. The market can't just flip a switch and produce more silver on demand. Let me tell you a story about what happened in the early 2000s. Silver was trading around $5 an ounce. Industrial demand was growing, but nobody was paying attention. The market was sleepy. Boring. Then something shifted. Investors started noticing the supply deficit. They started buying physical silver. Not paper contracts. Physical metal. Bars, coins, anything they could get their hands on. Within a few years, silver went from $5 to nearly $50 an ounce, a tenfold increase, and that was with far less industrial demand than we have today. What's different now? The deficit is larger. The industrial demand is more entrenched, and the investment demand hasn't even really kicked in yet. Most investors are still asleep at the wheel, focused on stocks, bonds, real estate. They're not looking at the commodity markets. They're not seeing what's building beneath the surface. Central banks are watching, though. While they're known for accumulating gold, some are quietly adding silver to their reserves. They understand something that most retail investors don't. When a commodity enters a structural deficit that lasts for years, the price adjustment can be violent and sudden. Markets can stay irrational longer than you can stay solvent, as the saying goes. But eventually, reality asserts itself. The COMEX, the major exchange where silver futures are traded, has seen its inventories decline dramatically. We're talking about drops of tens of millions of ounces. At the same time, premiums on physical silver have been spiking. When you go to buy actual silver coins or bars, you're paying significantly more than the spot price. That spread, that premium, is telling you something. It's telling you that physical metal is tight. Dealers are struggling to source inventory. Mints are running at full capacity and still can't keep up with demand. There's a fascinating dynamic playing out between paper silver and physical silver. On the COMEX, you can trade contracts representing millions of ounces of silver without ever touching actual metal. It's all electronic, leverage piled on leverage. But when someone stands for delivery, when they actually want the physical metal, that's when the system gets tested. And increasingly, the system is showing cracks. Think about the London Bullion Market Association, the LBMA. This is where the big institutional trades happen. Massive bars of silver changing hands between banks, refiners, and major industrial users. The LBMA vaults have seen significant drawdowns. Metal is flowing out to meet industrial demand, to satisfy investment demand, and it's not being replaced at the same rate. The float, the available supply that keeps the market liquid, is shrinking. Now, I want to take a quick detour here because this is important. If you're sitting on retirement savings, if you have $100,000 or more in traditional accounts, you might want to pay attention to what's happening in the precious metals space. I've put together a free guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're thinking about diversification and wealth preservation. No pressure, just information. All right, back to the silver story, because this is where it gets even more compelling. Let's talk about what happened in 1980. Silver hit $50 an ounce back then too. But that was driven by the Hunt brothers trying to corner the market. It was a speculative bubble that popped hard. This time is fundamentally different. This isn't speculation. This is real structural demand from industries that are growing, not shrinking. Solar isn't going away. Electric vehicles aren't going away. 5G infrastructure isn't going away. These are secular trends that will drive silver demand for decades. And here's the thing about secular trends. They compound. Every year, more solar panels are installed than the year before. Every year, more EVs are sold than the year before. Every year, more silver is consumed than the year before. Meanwhile, mine production is relatively flat. You can't just discover a new silver mine and start producing overnight. It takes years, sometimes a decade or more, to bring a new mine online. Exploration, permitting, construction, ramp up. The supply side is slow and inflexible. The demand side is fast and accelerating. Let me paint you a picture of what this looks like on the ground. There's a solar panel manufacturer in Asia. They need silver paste for their production line. They have contracts with suppliers, but those suppliers are telling them that delivery times are extending, prices are creeping up. The manufacturer can't just switch to a different material. Silver is essential to their product's efficiency, so they pay the higher price. They lock in supply. And that higher price gets passed along the chain until eventually it shows up in the spot price that everyone watches. Multiply that story by thousands of manufacturers across dozens of industries, and you start to see the pressure building. It's not dramatic. It's not a single event. It's a slow, grinding tightness that accumulates over time until suddenly it's not slow anymore. Suddenly, prices gap up. Suddenly, everyone is scrambling for supply. Suddenly, the market that looked stable yesterday looks chaotic today. We've seen this movie before in other commodities. Remember lithium a few years ago? Nobody cared about lithium. Then electric vehicles took off and lithium prices went parabolic. The market was caught flat-footed. Supply couldn't respond fast enough. Prices multiplied several times over before new production finally came online. Silver is setting up for a similar dynamic, except the deficit has been building for longer, and the industrial applications are more diverse. There's also a geopolitical angle here that most people aren't considering. Silver production is concentrated in certain countries: Mexico, Peru, China, Australia. If there's political instability, if there are trade restrictions, if there are environmental regulations that shut down mines, supply can get disrupted quickly. We live in an increasingly fragmented world. Supply chains that seemed secure a decade ago now look vulnerable. Countries are thinking about resource security in ways they haven't since the Cold War. China, for instance, has been a major producer and consumer of silver, but they're also thinking strategically about their resource needs. If they decide to restrict exports, if they decide to stockpile for their own industrial base, that removes supply from the global market. Other countries would have to compete for a smaller pool of available metal. Prices would adjust accordingly. Let's talk about the investment side for a moment, because this is where things could get really explosive. Right now, investment demand for silver is relatively modest compared to what it could be. Most investors don't own any silver. They don't think about it. It's not part of their portfolio, but when a commodity starts making headlines, when prices start moving, investor psychology shifts. FOMO kicks in. Fear of missing out. Suddenly, everyone wants exposure. And here's the problem. There isn't enough physical silver to satisfy a real investment rush. If even a small percentage of global investment capital decided to allocate to physical silver, the market would be overwhelmed. We're talking about a market that trades maybe $30 billion worth of physical metal per year, Compare that to the stock market, which trades trillions. If just 1% of stock market money tried to move into physical silver, it would be chaos. The ETFs, the exchange-traded funds that hold physical silver, would see massive inflows. They'd have to go into the market and buy metal to back those shares. That buying would push prices higher. Higher prices would attract more attention. More attention would bring more buyers. It's a feedback loop that can spiral quickly. We saw a taste of this during the Reddit-driven silver squeeze attempt a few years back. Retail investors coordinated to buy physical silver and silver ETFs. For a brief moment, the market got tight. Premiums spiked. Dealers ran out of inventory. Then the momentum faded, and things normalized. But imagine if that wasn't a brief social media frenzy. Imagine if it was a sustained move driven by institutional money recognizing the structural deficit. The outcome would be very different. Institutional investors are starting to pay attention. Hedge funds are looking at the supply-demand fundamentals. They're seeing the same data we're discussing. They're running the numbers, and some of them are positioning accordingly. Not with huge market-moving trades yet, but quietly, steadily, building positions. When institutions move, they move size. And when they move size in a market as relatively small as silver, prices respond. There's also the inflation angle. We've been through a period of elevated inflation. Central banks have raised interest rates to combat it. But the underlying drivers of inflation, the money supply expansion, the fiscal deficits, the geopolitical tensions, those haven't gone away. If inflation resurges, if confidence in fiat currencies erodes, precious metals become attractive. Gold gets the headlines, but silver often outperforms gold in those environments because it has the industrial demand component as well. Think back to the 1970s. Inflation was raging. The dollar was losing purchasing power. Gold went from $35 an ounce to over $800. Silver went from under $2 to $50. Silver outperformed gold by a significant margin. Why? Because it had both the monetary metal appeal and the industrial demand. It was a double catalyst. We could be setting up for a similar environment. Governments around the world are running massive deficits. Debt levels are at historic highs. Central banks are trapped between fighting inflation and supporting economic growth. If they keep rates high, they risk recession. If they cut rates too soon, they risk reigniting inflation. It's a no-win scenario, and the likely outcome is more currency debasement over time. In that environment, hard assets perform, commodities perform, and commodities in structural deficit perform exceptionally well. Silver checks all those boxes. It's a hard asset, it's a commodity, and it's in a deficit that's now entering its 5th consecutive year. Let me tell you about a conversation I had with a refiner recently. This is someone who processes silver, who turns raw material into bars and products. He told me that his order book is full. He's running 24/7, and he's still turning away business because he can't source enough raw material. The mines are producing, but it's all spoken for. Industrial users have locked in supply. Investors are buying. There's no slack in the system. He also mentioned something interesting about recycling. Normally, when silver prices rise, recycling increases. People sell their old jewelry, their silverware, whatever they have. That recycled material comes back into the market and helps balance supply and demand. But this time, recycling rates aren't responding as much as they used to. Why? Because a lot of the silver that's been consumed in recent years is in forms that aren't easily recyclable. It's in solar panels on rooftops. It's in electronics that get thrown away. It's dispersed in ways that make recovery uneconomical. So the traditional buffer that helped stabilize the silver market in the past is less effective now. The deficit is more persistent. The tightness is more structural, and the price response, when it comes, is likely to be more dramatic. There's a concept in markets called price discovery. It's the process by which markets figure out the true value of an asset based on supply and demand. For years, silver's price has been influenced heavily by paper trading, by futures contracts and derivatives. The physical market has been somewhat disconnected from the price. But as physical tightness increases, as the gap between paper and physical widens, eventually the physical market reasserts itself. Price discovery shifts from the paper market to the physical market, and when that happens, prices can move violently. We're seeing early signs of this shift. The premiums on physical silver are telling us that the spot price doesn't reflect the true cost of acquiring metal. Dealers are paying above spot to source inventory. Buyers are paying above spot to secure supply. That spread is information. It's the market trying to tell us something. Now, let's think about what happens if silver prices start to move significantly higher. Let's say we go from current levels to $40, $50, or beyond. What are the implications? For industrial users, higher silver prices are a cost increase, but it's a manageable one because silver is such a small component of most products. A solar panel might have $20 worth of silver in it. If silver doubles, that's an extra $20 on a panel that costs hundreds or thousands of dollars. It's not going to stop the solar industry. It's not going to stop EV production. Demand is relatively inelastic. For investors, higher prices validate the thesis. It attracts more attention. It brings in more capital. It creates momentum. And in markets, momentum feeds on itself. Traders see prices rising. They buy. That buying pushes prices higher. More traders see the move. They buy. It's a self-reinforcing cycle that can run much further than fundamentals alone would suggest. For miners, higher prices are a windfall. Their costs are relatively fixed, so higher silver prices flow straight to the bottom line. Their stock prices tend to leverage the move in the underlying metal. If silver doubles, mining stocks can triple or more. That's the nature of operating leverage. And as mining stocks perform, they attract investor attention, which brings more capital into the sector, which supports higher metal prices. Another feedback loop. There's also the strategic consideration for countries and corporations. If silver is entering a period of sustained shortage, if prices are going to be structurally higher, then securing supply becomes a priority. We could see more long-term contracts. We could see more vertical integration, where companies buy stakes in mines to ensure supply. We could see governments designating silver as a strategic resource. All of these actions would further tighten the market. Think about what China did with rare earth elements. They recognized the strategic importance. They controlled supply, and they used that control to their advantage. Silver isn't quite the same, but it has strategic applications. Military technology uses silver. Aerospace uses silver. Medical devices use silver. If you're a country thinking about technological independence, about supply chain security, you're thinking about silver. The United States used to have a strategic silver stockpile. It was sold off decades ago. Now, if the government wanted to rebuild that stockpile, they'd have to compete in the open market. They'd be bidding against industrial users, against investors, against other governments. That competition would push prices higher. Let me give you another historical parallel. In the early 2000s, there was a metal called rhodium. It's used in catalytic converters. Supply was tight. Demand was growing. Rhodium went from a few $100s an ounce to over $10,000 an ounce. 10,000. For a metal most people had never heard of. Why? Because the fundamentals were undeniable. Supply couldn't meet demand. Price had to adjust to ration the available supply. Silver is a much bigger market than rhodium. It's more liquid. It's more widely known. But the fundamental dynamic is similar. Supply is constrained. Demand is growing. Price has to adjust. The question isn't if, it's when and by how much. There are always risks, of course. A global recession could reduce industrial demand. A major new silver discovery could increase supply. Technological breakthroughs could reduce silver usage in certain applications. These are possibilities. But when you weigh the probabilities, when you look at the trends, the path of least resistance seems to be higher prices. The solar industry isn't slowing down. Governments around the world have committed to renewable energy targets. They've passed legislation. They've allocated funding. That's not getting reversed. Electric vehicles are mandated in many jurisdictions. Legacy automakers are investing hundreds of billions to transition their fleets. That's not getting reversed. 5G infrastructure is being built out globally. That's not getting reversed. These are multi-decade trends with enormous momentum behind them. And on the supply side, there's no cavalry coming. There's no massive new silver mine about to come online and flood the market. Exploration budgets have been cut. Permitting timelines have lengthened. Environmental regulations have tightened. Even if companies wanted to bring on new supply quickly, they couldn't. The industry doesn't work that way. So we have inelastic demand meeting constrained supply. We have a deficit that's persisted for 5 years and shows no signs of closing. We have inventories declining. We have premiums rising. We have industrial users scrambling for supply. And we have investors who are largely unaware of what's building. This is the setup. This is the powder keg. All it takes is a spark. Maybe it's a major industrial user announcing they can't source enough silver. Maybe it's an ETF seeing massive inflows. Maybe it's a geopolitical event that disrupts supply. Maybe it's just the slow, grinding realization among investors that the fundamentals are undeniable. Whatever the catalyst, when it comes, the move could be swift and substantial. I want you to think about your own situation. Think about your portfolio. Think about your exposure to commodities, to hard assets, to inflation hedges. Most people are overweight stocks and bonds. They're overweight paper assets that are denominated in currencies that are being debased. They have little to no exposure to physical commodities. And among commodities, silver is one of the most compelling stories right now. You don't have to bet the farm. You don't have to go all in. But having some exposure, having a position that benefits if this thesis plays out, that's just prudent portfolio construction. It's asymmetric. The downside is limited. Silver isn't going to zero. It has industrial value. It has monetary value. It has thousands of years of history as a store of value. But the upside, if the deficit continues, if investment demand kicks in, if prices start to move, the upside could be substantial. And here's the thing about markets. They don't wait for everyone to figure it out. They don't send you an invitation. By the time it's obvious, by the time it's on the front page of every financial publication, the big move has already happened. The early movers, the people who recognized the setup before it was consensus, they're the ones who capture the gains. Right now, we're still early. The deficit is known to people who follow the silver market closely, but it's not mainstream knowledge. Most investors couldn't tell you whether silver is in surplus or deficit. They don't know about the industrial demand trends. They don't know about the inventory drawdowns. They're not paying attention, and that's the opportunity. When you look at the totality of the evidence, when you connect the dots, the picture is clear. Silver is setting up for a significant move. The fundamentals are as strong as they've been in decades. The deficit is real. The demand is real. The supply constraints are real. And the price, at current levels, doesn't reflect the reality of the market. This isn't about speculation. This isn't about trying to time a trade. This is about recognizing a structural shift in a commodity market and positioning accordingly. It's about understanding that when supply and demand get out of balance for an extended period, prices adjust, sometimes gradually, sometimes violently, but they adjust. The silver market is sending signals. The inventories are declining. The premiums are rising. The industrial users are locking in supply. The smart money is positioning. The question is, are you paying attention? Are you seeing what's happening beneath the surface? Or are you going to wait until it's obvious, until prices have already moved, until the opportunity has passed? We're at a unique moment, a confluence of factors that doesn't come around often. Industrial demand at all-time highs, supply constrained, inventories declining, investment demand still dormant. It's the calm before the storm. And when the storm hits, when silver starts to move, it's going to catch a lot of people off guard. But you don't have to be caught off guard. You have the information. You understand the dynamics. You can see the setup. The choice is yours. You can act on it, or you can watch from the sidelines. But understand this. The silver market is at a shortage level not seen in decades. The deficit is real. The implications are profound, and the clock is ticking.